You just made a $10,000 profit on your investment. That's exciting, right? You look at your brokerage account, see the green numbers, and feel a rush of victory. But before you go out and celebrate, there's a catch. If you don't understand the rules of the game, the IRS might take nearly half of that profit. Not all profits are taxed the same way. In fact, how long you hold an asset can literally double or halve the tax bill you owe. Welcome to Fiscal Beacon, where we turn complex money concepts into clear, actionable steps. Today, we're demystifying capital gains tax. By the end of this video, you'll know exactly what you owe, why holding periods matter, and how to keep more of your money in your pocket. Let's dive in. First, let's define what we're actually talking about. When you buy an asset like a stock, a bond, or even a piece of real estate, and sell it for more than you paid, that difference is called a capital gain. It's called capital because it comes from your capital, your invested money. It's called a gain because you made a profit. Simple enough. But here is where most people get tripped up. The government doesn't just slap a flat tax rate on every single dollar of profit you make. Instead, they categorize these gains based on how long you held the asset before selling it. This distinction is the single most important factor in determining your tax bill. We have two main categories: short-term capital gains and long-term capital gains. Let's break them down. Short-term capital gains apply to assets you held for 1 year or less. Yes, that's it. If you bought a stock in January and sold it in December of the same year, that profit is short-term. Why does this matter? Because short-term gains are taxed exactly like your ordinary income. That means they are added to your salary, your wages, your freelance income, and taxed at your marginal tax bracket. If you're in the 24% tax bracket, you owe 24 cents on every dollar of short-term gain. If you're in the 37% bracket, you owe 37 cents. It's straightforward, but it's also expensive. The government wants to discourage trading, so they tax these profits at the highest rates you pay on your work. Now let's look at long-term capital gains. These apply to assets held for more than 1 year. If you bought that same stock in January and sold it in February of the next year, it's a long-term gain. Here's the good news. The tax rates for long-term gains are significantly lower than ordinary income tax rates. In fact, for many investors, the rate is 0%, 15%, or 20%, depending on your total taxable income. This isn't a loophole, it's a deliberate policy to encourage long-term investing and economic stability. By holding assets longer, you're not just growing your wealth, you're optimizing your tax efficiency. This is why financial advisors constantly scream, think long-term. It's not just about market volatility, it's about tax efficiency. Let's put this into a real-world example with actual numbers so you can see the impact. Imagine you are a single filer with a total taxable income of $80,000 from your job. This puts you in the 22% ordinary income tax bracket. Now, let's say you made a $10,000 profit on a stock. If you sold it within a year, that $10,000 is added to your $80,000 income. You pay 22% tax on that $10,000. That's $2,200 in taxes. You keep $7,800. Now, imagine you waited just 366 days. That same $10,000 profit is now a long-term capital gain. Because your total income is below the threshold for the 15% long-term capital gains bracket, which for singles is roughly up to $441,450 in 2024, you pay only 15% tax on that gain. 15% of $10,000 is $1,500. You keep $8,500. Do you see the difference? By waiting 1 extra day, you saved $700. It seems small, but scale this up. If you have $100,000 in gains, that's $7,000 saved. If you have $500,000 in gains, that's $35,000 saved. Over a lifetime of investing, the difference between short-term and long-term holding can be the difference between building significant wealth or watching it evaporate in tax bills. But wait, there's a twist. If your income is very high, things change. If your taxable income exceeds certain thresholds, around $496,600 for singles in 2024, you enter the 20% long-term capital gains bracket. Additionally, high earners might owe the 3.8% net investment income tax. So, if you're in that top tier, your effective long-term rate could be 23.8%. Even then, compare that to your ordinary income tax rate, which could be 37% plus the 3.8% NIIT, totaling 40.8%. You're still saving nearly 17 percentage points by holding long-term. The math is undeniable. The longer you hold, the less you pay. So, how do you apply this? First, be mindful of your selling dates. If you're close to the 1-year mark and you're in a high tax bracket, ask yourself, do I need the cash immediately? If not, holding that extra month or year can save you thousands. Second, consider tax loss harvesting. This is a strategy where you sell investments that are currently at a loss to offset your gains. If you have $10,000 in gains and $2,000 in losses, you only pay tax on the net $8,000. You can even use up to $3,000 of losses to offset ordinary income if your losses exceed your gains. It's a powerful tool, but it has wash sale rules you need to understand, so do your research or talk to a pro. Third, location matters. Where do you hold your assets? Investments that generate high short-term gains, like active trading or REITs, real estate investment trusts, generate income taxed at high ordinary rates. It's often smarter to hold these in tax-advantaged accounts like an IRA or 401(k), where you don't pay taxes annually on the gains. Conversely, investments that naturally grow over long periods, like index funds, are perfect for taxable brokerage accounts because you benefit from the lower long-term capital gains rates. This is called asset location, and it's a key part of a sophisticated tax strategy. Now I need to be clear about something important. I am an educator, not your financial advisor. The information I'm sharing today is for educational purposes only. Tax laws are complex, change frequently, and depend heavily on your individual situation, your filing status, your deductions, your state taxes, and more. State taxes can also apply to capital gains, and some states don't tax them at all, while others tax them as ordinary income. Before making any significant investment decisions or tax moves, please consider consulting a qualified financial advisor or a CPA. They can help you build a plan that aligns with your specific goals and legal requirements. Let's recap. Capital gains tax is the tax you pay when you sell an asset for a profit. Short-term gains, held 1 year or less, are taxed at your ordinary income tax rate, which is usually higher. Long-term gains, held more than 1 year, are taxed at preferential rates of 0%, 15%, or 20%, depending on your income. The strategy is simple. Hold your investments for more than a year whenever possible. Use tax-advantaged accounts for high-yield investments, and always keep accurate records of your purchase dates and costs. Money management isn't just about making money, it's about keeping it. Understanding these rules puts you in the driver's seat. You're no longer a victim of complex tax codes, you're a strategic investor. If you found this breakdown helpful, hit that like button. It helps the channel grow and reach more people who need this clarity. And if you haven't already, subscribe to Fiscal Beacon. Next week, we're diving into Roth versus traditional IRAs, which one wins in 2024. It's a head-to-head comparison that will help you decide where to park your retirement savings. You won't want to miss it. Thanks for watching, and remember, knowledge is the best investment you can make. See you in the next one.